Welcome to this explainer. Look, let's just jump right in because the first week of August 2026 is shaping up to be an unusually high-stakes period for global markets. We're talking about a rare, highly volatile window where macroeconomics, microeconomics, and geopolitics are all violently colliding at the exact same time. If you're managing a portfolio right now, or even just trying to make sense of the market's erratic behavior, you absolutely need to understand the powerful forces at play this week. So let's break it down.
Just looking at how incredibly dense this macroeconomic calendar is immediately sets the tone. We are expecting immense pressure across global markets in the coming days. Almost every single day has a major red flag economic data release that is fully capable of triggering massive swings. And it's not just one asset class in the crosshairs either. It's a relentless wave of fundamental data hitting everything all at once.
To navigate this storm successfully, here is our agenda for today. Number 1, the key events calendar. 2, DXY weakness risk. 3, gold losing luster. 4, oil war versus supply. And 5, equities, AI, and jobs. Let's get to it.
Section 1, Key Events Calendar, Macro Data Hits Markets.
Let's start with a high-level view of the critical data points acting as our ultimate catalyst this week because, well, knowing when the bombs are dropping is half the battle. The action kicks off right away on Monday and Wednesday with crucial U.S. manufacturing and services PMI data. That's going to set the initial tone for economic health. Then on Tuesday, we get a massive tech bellwether with AMD's earnings report acting as a real-time barometer for the entire AI and semiconductor space. But listen, all of this is ultimately building immense tension toward the final macro decider on Friday, the U.S. Nonfarm Payrolls, or NFP. This single data point is going to dictate the Federal Reserve's next move.
Section 2, DXY Weakness Risk, the Eye of the Storm.
We're entering the eye of the storm with our first major asset class, the US dollar index, or DXY. Honestly, it ended last week essentially on life support. Notice the steep, aggressive drop-off leading into the weekend. It was really struggling to maintain its footing around that critical 99.8 zone. The momentum here is undeniably downward, which really reflects a market that is rapidly repricing the greenback's overall value.
So what's driving this intense bearish pressure? Well, it's heavily tied to that highly disappointing 1.5% Q2 GDP print we saw. That lackluster growth number essentially evaporated the dollar's coveted interest rate advantage. You know, the yield that normally attracts foreign investment. Right now, markets are completely fixated on a seemingly inevitable September rate cut by the Fed, assuming the labor market is actually cooling down. While we might see a minor technical bounce early in the week, the overarching trend strongly points to more downside once the fundamental storms roll back in later on.
Section 3, Gold, Losing Luster, No Longer Attractive.
Moving over to gold. Now, you would expect a weak dollar to be a massive tailwind here, but we're actually seeing a surprising lack of traction. What's truly fascinating is the sheer divergence from textbook economic theory. Normally, a plunging US dollar combined with unrelenting, high-stress geopolitical tensions in the Middle East would send gold skyrocketing as the ultimate safe haven. Yet despite these massive traditional tailwinds, gold is fundamentally losing its luster in this environment. The current setup is leaving the asset largely unattractive to buyers, and it's pointing heavily towards lower price zones in the near term. Section 4, Oil versus Supply, a massive tug-of-war. Our third stop is WTI crude oil. This asset is currently caught in a volatile conflict that makes it incredibly dangerous to trade right now. It's the ultimate fundamental tug-of-war. On one side, you have the intense panic of war. Fears of massive supply chain disruptions through the Strait of Hormuz recently drove prices up nearly 7%. But on the exact opposite side, you have the cold, hard reality of fresh supply. OPEC Plus has officially started injecting an additional 188,000 barrels per day into the global market as of early August. We actually saw military escalation reports, not just rumors, but actual reports, push prices up to around $86.52, closing the week on a massive spike. However, I have to warn you, chasing this sudden jump upward right now is incredibly risky. The market still has to absorb the outcome of Sunday's OPEC Plus meetings. If that 188,000 barrel per day injection holds true, it acts like a giant bucket of cold water on this war-driven rally. The smart play? Wait to see exactly how the market digests this fresh OPEC Plus supply data before reassessing demand.
Section 5, Equities, AI, and Jobs, a fragmented market.
Finally, we turn to U.S. equities, where the broader indices are collectively holding their breath for a massive collision between the AI narrative and the reality of the labor market. The stock market is coming off a wildly divergent Friday that highlights just how fragmented sentiment actually is. We saw a spectacular 15.3% rally from Amazon, which essentially single-handedly rescued the broader market from what could have been a complete disaster triggered by Apple's steep 7.4% crash. Thanks to Amazon doing the heavy lifting, both the Dow and the S&P 500 managed to squeak out a relatively positive close. But a divergence this extreme, it shows a market that is deeply, deeply divided.
Heading into the new week, equities are trapped between two very distinct events. For the first half of the week, the fate of the entire tech-heavy NASDAQ is tightly chained to Tuesday's AMD earnings report. Notice the steeply declining trend line for AMD. Expectations are definitely not optimistic. If AMD delivers a negative outlook, it becomes a very gloomy barometer for the whole chip and AI sector, and that could aggressively drag down all the major indices.
But honestly, whether we rally or crash on Tuesday, everything this week builds up to the palpable tension of exactly 1930 on Friday. That is the moment the non-farm payrolls data drops, and it will undeniably dictate the macroeconomic flow for the rest of the quarter.
Here is the crucial point. The stock market is desperately hoping for a Goldilocks jobs report. It needs a number that sits right in the sweet spot. Think about it. If job growth is too hot, the Fed has the perfect excuse to keep interest rates higher for longer, which crushes equity valuations. But if job growth is too cold, it triggers widespread panic that a deep economic recession is already underway. It literally needs to be just right to guarantee that September rate cut without signaling an economic collapse.
From a purely analytical standpoint, this leaves the market incredibly vulnerable. If Friday's data misses that narrow Goldilocks window and comes in too extreme in either direction, investors have got to be prepared for a swift, aggressive correction to lower valuation zones across the board. The margin for error here is essentially zero.
Thanks for joining me on this explainer. As you prep your portfolio for this perfect storm of macro data, tech earnings, and volatile supply chains, you have to ask yourself one absolutely critical question. With a September rate cut practically fully priced into the current market, will Friday's jobs data completely shatter that narrative?